In the banking sector, Standard Bank has delivered upbeat earnings boosted by high interest rates. In the annual period, the group posted a 26% jump in headline earnings per share as its African divisions recorded a strong showing, overshadowing the tepid growth in the local operations. And joining me now is company CEO Tshabalala. Thank you so much for your time, Sim. Let's actually start off there at the top, because you said in your results commentary that in terms of the operating environment, 2023 was a year of two halves. And I'm wondering if you saw kind of those trends filtering through to the business and to the numbers.
Zanati, thank you very much, and it's always a privilege to talk to you. Yes, the first half of the year was significantly better. The operating environment was significantly better than the second half of the year. But I think the full year, produced excellent results for our group. Lots of tailwinds for us, high interest rates, devaluations in certain countries, positions that we took that benefited us, and a continuing growing franchise off the back of client activity. So it was a good year for Standard Bank in 2023.
Yeah, of course, you mentioned the benefit from the high interest rate environment. Of course, that growth that we saw in net interest income is no surprise. But actually, what interested me is the growth, the double-digit growth that we saw in the non-interest revenue. And actually, this is, this growth is not something that you see across the board in the banking sector. And, I just like to know what actually, puts Standard Bank in a solid footing in terms of that non-interest revenue.
Let's start with trading revenue first. Standard Bank has got the continent's largest, and dare I say it, the best global markets business on the continent. It provides risk management services to people that are exposed to foreign exchange, to interest rates, to commodities, and to equities. And that business in South Africa and in Africa regions has done great business in the service of our customers. That's the first one. So trading revenues were very, very strong. Secondly, and actually more importantly, the classic non-funded revenues that arise from taking deposits, providing clients with payment services, transactional services for the retail bank and also for the wholesale bank, did very, very well. They were up in double digits. And that is as a consequence of a larger number of customers in South Africa and in Africa regions, larger number of customers doing more with us, transacting more with us, whether it be in the cards business, in the deposit taking, or in the payments business. And yeah, you're right. It bespeaks a growing franchise both in South Africa and in Africa regions.
All right. Well, let's get to your credit impairments, because those increased 22%. Your credit loss ratio increased there, where it's now sitting at the top of your target range. What story is that telling?
It tells simply a story of high interest rates in the course of 2023, high inflation, and therefore customers starting to struggle, especially those that were finding themselves in difficulties in cases where people were losing jobs. It also then tells a story of jobs in the third and fourth quarter in South Africa starting to improve again, wage settlements higher than inflation and therefore improved disposable income, lower inflation towards the end of the year and lower inflation into 2024, and therefore the prospect of declining interest rates, and therefore a more robust and better positioned retail client base. It suggests that during the course of 2024, your bad debts will have peaked. However, your clients went into the cycle and out of the cycle in better shape than they did in previous cycles. How do you test that? By looking at the debt to disposable income ratio, as well as the installment to disposable income ratio. Both these ratios during this cycle are better than in previous cycles, bespeaking better balance sheets, people keeping their jobs, and a better ability to repay their obligations as they fall due. So in summary, a tough 2023, and improving 2024 for customers, with the result that at a Standard Bank level, at a group level, our credit loss ratio in 2024 we reckon will be at a similar level to what it was in 2023.
Sim, it is results season, and we've been getting a lot of companies saying that their profits have been hit by the higher debt servicing costs. And actually, talk to me about the appetite and momentum that you've seen in growth in your business loans.
Starting with individuals. So lending to people purchasing homes, cars, in their credit cards, in their revolving credit loans, and in their unsecured lending, that was in the low single digits. That growth was slower than it was in 2022. And that really bespeaks what you and I were talking about, the fact that people are finding themselves in greater difficulties, fewer people buying loans, buying homes, and fewer people buying cars. But it also speaks to greater competition. The South African market is fiercely competitive. On the corporate side, we saw people continuing to make investments in distributed power. In the renewable space, it is the fastest growing part of our business. I might just add, it's the fastest growing part of the business, both in the wholesale part of the business, as well as in business and commercial, and in personal and private banking. And so a faster growing loan book in the wholesale business, in corporate and investment banking, supporting the infrastructure rollout in the country in the nature of electricity, some of it in logistics, in the telcos, and then, of course, growth outside outside South Africa on the African continent.
All right. Well, we have run out of time, Sim. Thank you so much for your time and for giving us insight on those numbers and also where you are seeing a growth there. That was the CEO of Standard Bank, Sim Tshabalala.